All right, day 8, section 2. We just talked about all these reasons why banking crises could occur, right? All these reasons why banking crises could occur. So it's a reasonable question to ask, how in the world do banks ever then stay solvent, right? I mean, how do banks ever stay in business if they're so risky, if they have this problem that they're highly leveraged and that they're very vulnerable to bank runs, meaning people pulling their money out? And so, yeah, there's a couple of ways that banks can manage to stay solvent. Um, First, they mitigate risk through diversification, right? The best banks do find ways to be diversified, not just in terms of the assets they hold, but their sources of money. And this is one good thing that banks have been able to do here over the last 20 years is not only get into different, as we talked about on Monday, not only get into holding different kinds of assets, but also raising money in different ways, such as through commercial paper and negotiable certificates of deposit. So, banks are more diversified, and that has helped solidify um, them and make them a little bit less risky. Banks, though, can stay solvent by having a lender of last resort, an LOLR, a lender of last resort, somebody who's out there to help them in times of liquidity crunch. Who are the lender of last resort? Well, the Federal Reserve, the central bank, right? And we'll talk about this more toward the end of the week about the role of central banks in preventing banking crises and bank runs. But that is one of the primary functions that all central banks are supposed to serve, is to provide crisis in a credit crunch, or I'm sorry, provide credit in a credit in a provide credit in a credit crunch. Okay. So yeah, that's one of the things that central banks could do. And then in a big emergency, the federal government, right? The government's ability to lend money, right? Even over and above the um, the central bank is also an important, can be a potentially important source of lender of last resort funding. Deposit insurance, right, is one of the ways that we help prevent these self-fulfilling bank runs, right? So giving depositors some confidence that even if the bank goes bankrupt, they still will get their money back. And so we have not had any bank runs in the U.S., any full-scale bank runs in the U.S. since federal deposit insurance was established in 1933. And so, oftentimes deposit insurance doesn't even have to be used. Just the psychological impact of knowing that is there is enough for a lot of people, right? For most people. And then, of course, banks stay solvent because they get regulated. And one of the purposes of regulation is to prevent banks from engaging in extremely risky behavior. That doesn't mean that it always works, but it does mitigate it to some extent. And there's a lot of empirical evidence that a lot of banking crises in history have often followed deregulation, meaning banks have been deregulated and have been able to get into activities that they weren't able to get into before, and then that can lead to a crisis, right? It can lead to a crisis. How do governments respond to banking crises? Well, first, hopefully the government is providing deposit insurance and making sure that deposit insurance continues to be there to keep depositors from pulling all of their money out of the banking system and triggering an even bigger crisis. The central bank, as we said, has to serve as a lender of last resort to banks. And then finally, there's possibly a role for the federal government to be involved in bank bailouts. And we're going to talk about what these bank bailouts look like when we talk about the 2008 banking crisis here in a couple of minutes. But of course, deposit insurance and central banks lending as a last resort and bank bailouts, they have problems with them. And the big problem is, they create moral hazard, right? If banks engaged in risky behavior and then they get bailed out and they don't suffer the consequences, there's always the worry that it's just going to lead them to engage in more risky behavior in the future, right? That's the moral hazard problem associated with bailouts and lender of last resort. Bank bailouts can be very costly, right? In history, we've seen bank bailouts in some countries that have cost up to 100% of GDP or more, right? In other words, a whole year's worth of GDP spent on trying to bail out banks. That's an amazingly high amount of money. Now, as we're going to talk about, the bank bailout in 2008 didn't cost nearly that much, not even close, but it could have, right? It could have. If things have gone worse, it could have cost even more. And then there's also this political problem, right? Whenever you're bailing out banks, you have to pick out who fails, who gets bailed out and who doesn't, right? This was a big question during 2008 when Lehman Brothers, one of the biggest investment banks, did not get bailed out and they failed. And a lot of people said, why didn't they get bailed out, right? What was going on? And so this political question related to bailouts is a really, really important one. And we're seeing this question discussed today when we talk about the pandemic, right? Part of the response to the fiscal policy response to the pandemic was creating this fund that the Treasury can distribute to small businesses to help them survive this pandemic. But who gets this money? Does every small firm get it? What about the ones who don't need it? How do you determine who needs it and who doesn't, right? And of course, the problem with, kind of debating, well, who gets it, who doesn't, who fails, who doesn't, is of course there's this issue of fairness, right? But even deeper, there's a question of speed, right? The more time that you spend arguing over who gets the money and who doesn't, the slower the money gets dispersed. And as a result, the more the crisis can build. And, we see this trade-off going on right now, right? Where there's many people that are pushing on just kind of giving it to everybody, right? Get the money out there, give it to everybody. And then there's other people who say, well, but I'm not so sure that these kind of banks should be getting it, or that we don't want the Trump people to get it, or, there's a lot of this kind of back and forth. And unfortunately, that's going to make any bailout more costly. Well, I don't know about more costly, but it's going to make it less effective. The empirical studies on banking crises come to kind of four conclusions. First off, usually it's financial liberalization, meaning deregulation, that often precedes banking crises. Also, what tends to precede banking crises is new financial technology, right? New technology allows banks to do different things than they've done before. Maybe these different things are not closely regulated. And it also begins to fuel this time it's different psychology, right? Which we know time and time again happens during financial crisis, right? People convince themselves that this time it's different. Don't worry about it. The boom will never end, right? And then of course it does. Obviously, we know that banking crises are a lot more likely to happen when there's poor financial fundamentals and high leverage, right? The higher the leverage, the less cushion banks have, the lower the profitability of banks, the less cushion they have, the more likely they are to fail. And then, of course, we know that asset bubbles, right? When stock markets and real estate markets and bond markets are way overpriced, we know that makes banks vulnerable, right, to crises. And so these empirical studies really just confirm our intuition and confirm that both belief-based and fundamentals-based causes of banking crises exist in the real world. What are the economic costs of financial crises? There is a wide variation, right, in terms of lost output and the cost of bailouts, right? There's a lot of variation, but in general, here's kind of some summary statistics. And once again, these are just averages, right? We have many examples of crises that cost more than these and many that cost less. So there's a lot of variability. But usually during a financial crisis, you can see housing prices go down by 35%, stock prices go down by more than 50%, unemployment rise by more than 7%, and last in remaining high for almost 5 years. Real GDP falling by 10% and staying low for almost 2 years. Increases in government debt, oftentimes from bank bailouts, can increase debt almost by 86%, almost double the amount of government debt, right? So that's very, very costly, right? Specifically, when you look at banking crises, when you have a banking crisis, you can expect the recession to last about 2 years and GDP to fall about 9%. So, very, very costly, not something that you want to happen. And then so I guess maybe one of the conclusions here is that if we look at all of the major economic contractions in modern history, right? So not looking at just small recessions, but the major recessions, they have all been associated with a financial crisis, right? And so in some sense, what's the difference between a recession and a depression? It's whether you have a financial crisis or not. And that's really, really relevant to what we're talking about today, right? Because when we think about what are the economic impacts of this pandemic going to be, we really have to think about it. Is it going to trigger a financial crisis? Right now, we've had a drop in the stock market, but not even a huge drop. I think as of today, the stock market's down maybe 12% roughly. That's not really big enough to be counted as a stock market collapse. So to this extent, we haven't had a financial market collapse. But if we do, that pretends something much, much different, and much, much more serious going forward. In emerging market economies, what we tend to see is financial crises also tend to be associated with sovereign debt crises and currency crises, which only aggravate the problem. So anyway, that's kind of some of the impacts of banking crises. And so, let me just reiterate here that in many ways, what separates a recession from a depression is whether you have a banking crisis or not. And so are we headed to a recession or something much more serious? I think a lot of it has to do with how solid our banking system and our financial markets are. So to that end, in the next section, I want to talk about the 2008 financial crisis, learn a little bit about that, and then move on and talk a little bit about what's going on today with the pandemic and how we might understand that in some historical context. So back in a moment.